The way that I personally counter it is rather than trying to predict what's going to happen next, because at the end of the day, you actually can't. People who set out on this journey to predict price, I think they've set themselves up for failure straight away.
If I think about it as an investor, how to think about investing in Bitcoin? What is the framework you go by?
Unless you can write down on a piece of paper and say, this is why we're going to get this right, I just don't think that there's much edge in it. What you can do is...
Meet James Check, better known as Checkmate on X.
As one of the world's top Bitcoin on-chain analysts and the former lead at the renowned Glassnode, James has now launched his own brand, Check on Chain.
His mission: to educate investors on Bitcoin's market dynamics through insightful analysis and engaging content.
Not only do I think that this is a good idea, I think this is the idea. I think that sets most people up for a much, much more successful time in markets.
Where are we right now if we look at these on-chain indicators?
I've really narrowed it down to one thing that drives markets, and that is...
How should a Bitcoin investor invest? Is it just buy and hold, or is it a bit more nuanced?
A lesson that I definitely learned is...
Hello everyone, great to have you guys back, and also great to have my second episode now running. And I'm doing it with a really special guest. It's James, Check on Chain or Checkmate on X. I mean, most of the people who are in Bitcoin and crypto must have heard of him. He's really one of the, I would at least say, one of the highest signal people on my side that I've been following for a couple of years. And I'm really honored to talk to him today. So James, thanks for being here and taking the time and giving us your time.
Thanks, mate. No, it's really good. I always like when these podcasts spring up because it's, it's just about sharing information, and Bitcoin open source. It's always been about this kind of open knowledge sharing. So thanks for having me on.
Yeah, sure. No, great. And there's certainly a lot of things that we can learn from you. I hope so. That's going to be great. Well, maybe just to start off quickly, I mean, for people who might not know you, because I also have a few people from traditional finance, who are just like keeping or putting their toes into Bitcoin for the first time, and they're like really curious. So who are you? What is it that you do? And maybe just quickly, how did you get to Bitcoin after all?
Yeah, great question. So my background is civil engineering and a specific type of civil engineering, which is called geotechnical. So I used to design everything to do with the ground, tunnels, basements, foundations, mines, anything where we're excavating, essentially. So the link, I found Bitcoin in 2018. It was I think I bought the absolute Pico top in the 2017 market, as we all do. First thing I ever bought before in my life. And something about markets, right? Even though the price is down, I'm turning, $10,000 into 10 cents. Something about the way that markets moved fascinated me. And the kind of connection here is a lot of the work we do in geotechnical is risk, it's uncertainty, where you're dealing with very, very, very incomplete information to design very complex structures. So as a result, you get very used to dealing with what could be, having very flexible designs, and markets are all about that. We never know what everything's going to do, and they're infinitely complex systems. So when I started seeing with Bitcoin, and I became fascinated with the Austrian School of Economics and all the different reasons why Bitcoin is a solution to the world that's coming, but that's a separate topic. Ultimately, on-chain data is the thing that kept me here. And it's essentially analysis of Bitcoin, kind of combining that risk framework, big data, modeling, turning complex information into simple stories. And ultimately, that was my hook. And that's how I got into the space and started doing it professionally.
Great. Yeah. Awesome. I think that the thing you just mentioned, with markets being so fascinating and just also unpredictable, I mean, that's something that fascinates me as well. And that's also why I called my podcast Less Noise, More Signal. I'm always trying to look for the signal, like we all are, but what would you say from your experience, like where does the signal really lie in all of this? There's so much things you can look at, on-chain technical analysis, trend analysis, sentiment, but is there any signal in all of this, or is it all just noise?
Oh, this is a fantastic question. So I will relate it back to my engineering world, which is quite often you can solve very complex problems on the back of an envelope and you'll get within plus or minus 10%, right? So generally speaking, the remaining 10% of that problem is going to take you a long time to solve, and you have to solve it because that's, the devil's in the details. However, you're going to be within the ballpark with simple checks. And I think that markets are very much the same. There's a lot of factors. There's an infinite amount of factors. the weather in Peru probably does affect the price of coal in some way, shape, or form. But is it enough to do a whole lot of deep dive work on? Probably not, right? So it's about like structuring what really matters and what drives the system. And in my experience, I've really narrowed it down to one thing that drives markets, and that is human beings. And I love this angle because ultimately it is our emotions and our capital that creates markets, right? Because at the end of the day, people feel bullish on things, they buy it. People feel bearish on things, they sell it. And you get this interesting dynamic where interest rates can change and market conditions can change and asset prices. The one thing that will never change is the human being reaction function to fear and greed. We will always behave the same. And I use that as my anchor with a lot of my analysis to look at what are the human beings doing? How are they feeling? What is their overall behavior patterns? Because ultimately that's the thing that's going to drive markets anyway.
Mm-hmm. Yeah, that's so interesting. I mean, studying human beings, that's really, I think, where you have to go down and, or like what route you have to go down at, But the thing is, like, when it comes to me, that's also kind of the irony of it. I've been trying to study human beings as well, first and foremost myself, and that's what fascinates me, because like you obviously you consume a lot of information, all about data, about the market. You are on X and on other platforms, but then always what I kind of figured out is that whenever I would have probably taken the right decision is if I had kind of counter traded myself even,
Yes.
Because I'm also then one of these people who gets greedy, and then sometimes you're, okay, now it's probably the best time to buy. And looking back at myself and what I did, it would have probably been a really good indicator, just counter trading myself. And I don't know if you have had a similar feeling yourself.
Oh, it's very real. And even though you can spend a lot of time in markets and master it, so to speak, if you do not practice being that kind of really critical thinker, you will naturally fall. It's a constant fight. You will fall back in your old ways and you will start making those same mistakes. So I think a big part about markets is it is about yourself. And I often describe markets as the tide. You can't fight the tide. You can't change the tide. It just is. It's bigger than all of us. You can swim against it, but you're going to drown. So at the end of the day, the market's going to do what the market's going to do. And I think respecting the fact that markets, and when we talk about markets, we're usually talking about price, we're looking at indicators, fundamental data, whatever it is just information. That's all it is. And I think the way that I personally counter it is rather than trying to predict what's going to happen next, because at the end of the day, you actually can't. And I think that people who set out on this journey to predict price, I think they've set themselves up for failure straight away. You got to do some serious quant, unless you can write down on a piece of paper and say, this is why we're going to get this right. Until you can do that, I just don't think that there's much edge in it. What you can do is prepare. So rather than trying to predict, the price will be up 5% in the next 2 weeks, instead you go, well, if the price goes up 5%, what am I going to do? Am I going to sell? Am I going to buy more? Is that a good sign? Is that a bad sign? What if it goes down 5%? Just having thought about what will I do, not about what it will do, what will I do given those certain sets of circumstances, I think that sets most people up for a much, much more successful time in markets. Yeah,
exactly. No, that's a great way to frame it. I mean, just like preparing for what's to come and not actually predicting what's coming, because it's just impossible. But then maybe one question I would have, because I see it myself when I talk like to my inner self and then also to other people, most people nowadays, when it comes to Bitcoin or other assets, they are kind of like, because they don't have the time to just look at it all the time. So they are kind of like positioned as investors, I would say investors is more long-term framed, where you really are in for the long term. But at the same time, when you track the way they're thinking and what they're kind of like contemplating over, it's more like they're behaving like a trader, like, okay, it's going down 5%. Oh, should I sell now? Even though maybe they are positioned as an investor. And I would like to ask you, how important is it that you kind of differentiate between these two terms and then also come to terms with that, what you are eventually,
I think
investor or trader.
Mate, this is such an absolutely fantastic point. And it is a lesson that I definitely learned, is to separate and understand and appreciate which part of me, and you can be both, right? You can be a trader and an investor. You can have 90% of your portfolio that you just buy and hold and the other 10 that you trade around. Those things are absolutely true. But you are 100% spot on, dead on the money, that people who call themselves hodlers will check the price chart every single day and they'll experience all of the same emotions as a trader. And it can kind of go both ways, because some people will just go so far down the rabbit hole and become like the ultimate investor, and then they regret not selling, or they regret doing, like, they don't make the longer term decisions of going, well, maybe actually, if I was to sell a little bit on the rally, maybe I could actually survive and have more dry powder on the way down. But at the same time, many investors, it's like they don't plan to sell, right? They're here for the very, very long term. But knowing which one of those buckets, and it's similar to preparing, having your plan. Are you actually trading around, right? Are you holding 90 and selling 10? Are you holding 100? Are you trading 50? How are you actually framing this up? Because you will get sucked into all the narratives. One of my favorite lines is, I love seeing the narratives on Twitter not playing out in the data, because it happens all the time. People are like, oh, it's this, and this. And you look at the data, it's like, well, I can't see it. I can't see any of these things that people are talking about, but that's the narrative. And people get stuck to this kind of stuff, and it may not be what's really going on.
Yeah, for sure. No, and just one thought that really springs to my mind is that what's so fascinating, or what fascinates me a Bitcoin, when I think about it in these like broader terms, it's really, Bitcoin is often usually called by critics, it's a cult, it's just really people all get really immersed in, and then they don't see anything else. But if I think about it, like as an investor who's in for the long term and doesn't want to have this whole day, like day-to-day ups and downs, it might actually make sense, if you have like true conviction. And that's probably what Bitcoiners have, because they study it and they kind of get drawn into it almost religiously, but this could actually help in the end, even though I would say I've been in the space for quite some time. I studied Austrian economics, all these things. And I even see myself sometimes really getting back into this trader mode. But it probably helps, if you have an asset that you can truly have conviction in, and it's probably one of the assets you can have the highest conviction in, because there's so much also philosophy and all these things around it. That's not something you find usually with a normal stock or equity, right?
No, absolutely. And there's so many, Bitcoin has taught me a lot, and more than anything, to be honest, the number of rabbit holes you get taken down. Like, I learned about energy grids because of Bitcoin. This is just one of those things you just don't expect, right? Suddenly Bitcoin's plugging into energy grids and stabilizing things, and it's incredible. Now there's a cross current with AI and all the power generation there. All these things, like Bitcoin takes you down these intellectual rabbit holes, on-chain data, just understanding all the human psychology that happens inside Bitcoin. It's like, to me, it's fascinating. So it really does take you down those rabbit holes. I'm a big advocate for, if you don't understand something, there's like I forget who it is, but one of these market sayings, if you don't understand something, you probably shouldn't own it. And the flip side of that is, if you understand it very well. I spend every day of my life looking at Bitcoin. I counter, I'm like you, right? Bitcoin is a huge part of my net worth. And I look at it, if anyone else in the TradFi system saw my portfolio, their head would explode. But I understand the thing I own better than anything else. And I would take it so far that I also like things like gold. I like things like energy stocks. I wish I had the on-chain tools I have, because I actually feel blind. I cannot see what's going on in those markets. And, thick curveballs, literally in the last couple of months, certain stocks that I've had that have been performing very, very well just suddenly don't perform well because of a news headline or this event or something that you just can't see coming. Bitcoin, I can see everything coming because it's a public database, and I could just explore that. I wish I had this level of transparency for all these other assets. So I think in terms of the conviction, knowledge is just so important. Having conviction built on tools and things that I know when Bitcoin is healthy and I know when it's not. And I can make calls according to both of those two frameworks.
Yeah, that's so interesting, because I think that's what also helped me, even though some of the things you can also know in retrospect, or only in retrospect, as you said, because we can predict the future. And even if we look at on-chain data and stuff, it's probably hard to, like, with certainty predict the future. But at least in retrospect, also you can make sense of things, that like, okay, now I understand, because like things have been moving or deteriorating in this way, and now it all makes sense. It adds up. So that's also a level then, or a bottom that you can build conviction on again. So that's really interesting. But maybe just because we're now on that topic, before we move over to these on-chain things and how we can use these tools, maybe just one last question on Bitcoin in general. So if I think about it as an investor, how to think about investing in Bitcoin. What is the framework you go by?
Yeah, so I mean, I look at this and I kind of go back to my 2019 self. So in 2019, I would still consider myself a retail. I mean, I am retail, right, in terms of size, but I think there's a very different characteristic in Bitcoin where retail, it is a grassroots phenomena. So in many ways, people like myself have spent the 10,000 hours to become experts in understanding Bitcoin, the markets around it, the data around it. TradFi is only just starting that process. So in many ways, Bitcoin is a unique asset where retail actually understand it better than the TradFi world, right? That will change over time, but for now, retail has a very, very interesting edge. Now, I go back to my 2019 self. Why did I start seriously buying Bitcoin back then, right? It took me a couple of years to learn about markets and learn about what Bitcoin was, but it clicked to me. It truly clicked to me when I started to understand the monetary system. And then you just realize, like, in many ways, I would have been a gold bug, right? And I think it carries a lot of the same characteristics as gold, no question. But the difference is, and I've been using this analogy recently, I actually recommend to Bitcoiners to go and buy yourself a stack of silver coins, buy a single gold coin, and then compare the size and weight of the silver stack of coins, which is worth not very much, to the gold coin, which is worth a decent amount, and it's quite small, to the Bitcoin, which weighs absolutely nothing and takes up zero space. Exponential improvements in value storage. Then you start transferring it around the world, right? I have been paid and I have paid people in Bitcoin. And in many ways, it's actually easier to use Bitcoin than it is to use the fiat system. Because if I've got to convert my Australian dollars into US dollars, I've got to find a bank that does that. We were traveling in the US. You can spend and buy stuff, but we actually wanted to go and buy some silver gold eagles. Cannot use an Australian credit card. So you actually can't buy things when you're overseas. It was actually easier to buy the silver coins with Bitcoin because it was global, right? And it's a uniform asset. So there's a lot of reasons why Bitcoin makes sense. But when I look at the world that we're in, the currency debasement, all the arguments that make sense for gold, and the reason why gold is ripping higher right now, they apply to Bitcoin, but it is exponentially better. And the world is going to work this out. It's not a question of it might or it could. It will. It just takes time. Like the internet, these things take time for the people to just click. It makes sense. And it suddenly just becomes a part of everyone's day-to-day life. It's going to get there.
Yeah, great way to put it. I mean, if I would summarize it, is then you have, like, on one hand you have the technology, which is just better, as you said, it's just global, it's permissionless, you can take it anywhere, and you have to ask for nobody's permission, which is just amazing, and then on the other hand you also have this angle where this absolute scarcity comes in, and then it kind of resembles gold again, maybe even better on that front as well, and it's just perfect made for the time that we're in. So you have, like, these two angles where you can look at it. You really have the scarcity, the absolute scarcity, which makes Bitcoin unique. And then you also have the technology underlying it, which just makes it better because it's on faster rails and it's just easier to handle in the end, And that's also for me then where there's something for everyone in it, like if you are an ETF holder of Bitcoin, you might not be invested or you might not profit from, like, the technology because in a sense, you're holding it in an old wrapper, old world wrapper, but still you're profiting from this other angle, the 21 million hard cap, which is in there. So again, if you're using it, as you said, in the US or somewhere else, then you're using the technology. So there's something in for everyone, I feel like. So that's very interesting. The question I would have is like, okay, if I understand this and I see, okay, it is a unique asset, then the question really becomes again, how should a Bitcoin investor invest? What's the best way to invest? Is it just buy and hold, or is it even a bit more nuanced?
Yeah, I mean, that's a great question. And again, it comes down to personal positioning, right? Working out what are you holding it for? So for me, I'm holding my Bitcoin for a long period of time, right? Decade. Because when I look at its performance, it is the best performing asset most of the time, which is kind of amazing, right? And continues to be so. For me, my inflation rate is the Australian housing market, right? Because, I'm at the age where I want to buy a house. And I'm at the unfortunate age where the house has always been running faster than the growth in my income. Now, if we just look at the 2020 to now period, right? Because in many ways, the inflation that we've seen, the monetary debasement, all that stuff, going from the 1st of January 2020 to now, the average Australian home has gone up by about 45%, which is pretty dramatic, right? It's gone down 75% in Bitcoin terms. I can buy 4 times more house with my savings than I could. So I'm actually finally starting to catch up, right? So this is ultimately what Bitcoin is doing for me. It is my store of value. It is storing my time, and it's allowing me to buy the thing and outrun the inflation rate that is specific to me. So in many ways, getting and you can run a whole bunch of studies, whether you're a portfolio manager, whether you're a trader, whatever it is. There is a whole range of studies you can run where the biggest increase or improvement to portfolio, because contrary to all the narrative, right, Bitcoin's too volatile, it has big drawdowns, blah, blah, blah. If you add Bitcoin to a portfolio and you run the actual numbers, it improves Sharpe ratio and it actually reduces drawdowns, because the performance to the upside and the volatility, which, by the way, volatility increases to the upside for Bitcoin. It's much more like a commodity in that sense. Whereas for stocks, volatility decreases on the way up. Bitcoin's the opposite. So higher volatility actually means Bitcoin's going up, counter to people's opinion. It improves Sharpe ratio. And the biggest improvement to anyone's portfolio is when you go from 0 to non-zero. That is by far and away the biggest delta. Then when you're going from, if you go from 0 to 1%, that's the biggest difference. If you then go from 1 to 2, 2 to 4, 2 to 5, it improves incrementally. But that 0 to 1 is the thing that really makes a huge difference in portfolios. And for most investors, 1% is irrelevant, right? If you lose it, that's fine. The whole market goes up and down 1% a day. So 1% is something that people should be comfortable with. And ultimately, once you've dipped your toe, the process is then you've now got something to study and learn about and understand. And once you go down that rabbit hole, people will be surprised. I'm yet to find, maybe with one exception, Nassim Taleb, I think, is the only one who's gone down the Bitcoin rabbit hole, then pulled himself out and gone, no, I don't want it. I've never met someone like this. Most people go down and they go, okay, now that I get it, and I make sense.
Yeah, great. Yeah, Nassim Taleb, we all know him. Maybe he's not being intellectually honest, but who knows? But what you said just now, it's so interesting that you bring this up, because I now work as a crypto or just like Bitcoin investment manager at the bank, that I'm a part of the investment team. And that's really also how it clicked for me when I got there. I was always trying to sell Bitcoin in terms of its monetary policy, which is just better than the normal one and everything. And people were like, who cares, But now I work at the bank, I can really see how it works, how you kind of bring it across to people, and it's really number go up. Or as you said, then if you add it to a portfolio, you show these people what it does to a traditional portfolio, and then they're like, wow, crazy, you back test it, and then it just works. I kind of have to do it, because as you said, the downside is just limited, but the upside is potentially so much bigger. And that's why I kind of feel this is really the way it works, So
there's been studies done on this before where you pretend Bitcoin, remove the name Bitcoin, just pretend that it's a hedge fund, and then do the rap sheet, look at the performance, look at the Sharpe ratio, remove the name. If it looks good, now you got to justify why the hedge fund called Bitcoin is not worth putting some money with.
Yeah, exactly. Yeah, that's a good way to put it. Blind it all out, and then people will just do it because the numbers, it's all in the charts.
Yep.
Yeah, the numbers make sense. Yeah, great. So but now personally, if you are kind of convinced, because I'm kind of asking myself, that's what I've been hearing as well. Also the housing example that you've given, it's great, because I feel I'm in the same position. And then some people know that I've been in Bitcoin for 7 to 8 years, and they know that even though I was a student back there, I also invested what I could, and then they're like, nowadays, dude, you have to sell, at some point you have to sell the asset, Michael Saylor, it was asked the same thing, why don't you do it? And I'm always like, what would I sell it for?
Correct.
Because I need a goal. But then in the end, also, I'm kind of like, they also tell me, but you can sell and then buy in lower, because you see the volatility. And I'm really asking myself, is that too dangerous? Or what are your thoughts on there,
There's a fantastic timing on asking this question, because I've spent all day today trying to solve this riddle specifically. So my piece tomorrow will actually cover something along these lines. And so a bit of an inside scoop. What I was basically looking at is, of Bitcoin's price performance, how often does it do something? Because right now we've been in a basically sideways grinding choppy market for 6 months. Now, if you can believe it, 33% of all Bitcoin days, if you just take every day, is it an up day, a down day, or plus or minus 1%? More than a third of all Bitcoin days are plus or minus 1%. So a third of the time, it does absolutely nothing. And this is what a lot of people don't understand, is on a daily time frame, it's a perfect bell curve where it does nothing most of the time and something at the extremes. But when you look at things on like a monthly or a quarterly and you zoom out and you actually look at, okay, what if I was to hold this thing for, 3 months or for 9 months or for 12 months? Suddenly, there's about 10 to 12 days in any period of time where you get the maximum returns. And these things are like plus 100% quarters. If you're not there for that 100% quarter, you lose, right? Because you have to be there in advance of those moves. So as I kind of go through this whole study, the last thing I said is, okay, I'm going to look at some key periods in time, 2019, 2021, and our current market. I'm going to remove the best 10 days and the worst 10 days, right? So there's two cases there. You missed the rally because you sold and you're like, don't worry, I know where it's going to go. And you tried to predict, but you didn't prepare. So you're out of the market and you missed the 10 best days. Or you're trying to sell because you think you're going to buy back later, or you're trying to like hedge your position. What happens if you miss the worst days, which in theory is what a lot of portfolio managers try to do, right? Minimize downside risk. When you run that study in 2019, 2021, not quite yet in this current market, but getting close, if you miss the 10 best days, you break even. You have zero return. If you just sat there and allowed those 10 best and worst days to happen, you're up like 350 to 400% in those periods. If, on the other hand, you manage to hedge out by some miracle, you only hedge out the 10 worst days, you add about a 2x multiplier to your performance. So then you've got to think about what work do you need to do to miss those worst 10 days. It can be done, but it's not easy. Very, very difficult. This is what the quants do. So basically, for the average hodler, for the average investor, unless you're building really complex models, don't worry about the 10 worst days because your returns are still going to be good. If, on the other hand, you think you're going to be smart and play the game and you miss 1, 2, 5, 10 of the best days because you thought you were going to buy back lower, those returns evaporate and then you've missed it. It's gone. That is something you cannot unwind the clock. So in many ways, just being in the market is the game, right? Surviving it and buying low enough is the game. Worrying about selling and buying back lower, I think it's a fool's errand.
Yeah, so nicely put. I mean, I saw something similar, maybe not as nuanced as your take, but really when I was pitching it to some of the investors that we usually talk to, I was also looking at it on it was like 10 years period, and then you go like, okay, if you scrap off or take off the daily return days, the 20 best daily return days, like your performance just collapses. Like it's crazy. You have something 7,000%. And if you take these 20 days off, it's down to 300%. And then you can also see within 10 years, just like not being in there for the 20 best days would have cost you almost all the performance. So that also kind of was a moment for me where I was like, okay, now that's why you want to be in that asset, because you just don't want to miss these like really short days where it actually really pumps, So.
And the thing that I wanted to really answer in mind, because a lot of people, when they do that study, they're like, oh yeah, but you're looking at the 2012 data where it went from $0 to $15, right? I cut all that out. I'm only looking at 2019, just that window of time. 2021, just that window. So it's the same story all the way around. And the strange thing is, I'm almost positive if I ran the same story, the same analysis for any asset, gold, Nvidia, Apple stock, whatever, I'm almost certain that you will come up with almost the exact same thing, that most of the time the market does nothing. And then you just get these fantastic return days where everything just flips to the upside. So, and the other thing I just say is that, a lot of people, and I've had this from a lot of my friends as well, and they say, just sell now and buy back later. To which, I have a standard response now. It's like, okay, based on what? If you think you can sell this thing and then buy it back later, maybe. But please write down on a piece of paper what your edge is that helps you to do that. I know that I could actually do that because I spend all time in the data. But I find it very interesting when people who have no experience in markets have a whole lot more of an idea about how to trade this asset that is my profession to understand. I find it so fascinating because it's like, it's that human, I don't know what it is. It's like a confirmation bias that exists. Like, oh, because I don't own this thing, I know how to trade it better because, I made the right decision by staying out of it. And ultimately, I think that's a big part of it. People feel like they've missed the boat. So they would rather be told you were right. It's a scam. It's for this. It's for that. You shouldn't have owned it. No, you did the right thing by ignoring it. And it's a more painful pill for people to swallow to go, hang on a second. What if this actually makes a lot of sense? What if I just look at it one more time? And I think that's a switch that's hard to break.
Yeah, exactly. I mean, that's the same thing with my friends, because I feel like they have this confirmation bias as well, and also just no skin in the game in the end, because they can look back in retrospect and say, yeah, it's been so volatile. It would have been easy, to go out. Everyone would have seen it, because there were all these top signals, like a whiff token on a sphere, that this is the top. But obviously, it's so hard. It's always easier in hindsight and not if you're actually in the present to really predict something like this. So that's why I kind of figured for myself, I have this strategy. I call it enhanced DCA, and I don't know if it makes sense to you, but then I don't try to time the market to actually sell and buy back lower, but I'm trying to figure out the times where it might be good to buy to actually, because I just see I will be a constant marginal buyer of Bitcoin, because I also have the conviction that you need, so that's kind of like, do you see any merit in this, just don't sell it because if you don't need it, but then also maybe try to figure out when is the best time to buy. And usually it's the best time when there's blood in the street, right?
Yeah, no, I not only do I think that this is a good idea, I think this is the idea. This is literally how I think, and when people first get into markets, don't try and look at every indicator, just dip your toe, get off the zero, get to 1% of your portfolio so you can experience it. You need to experience the volatility to get comfortable with it. Once you've been in the market long enough, the strategy you just described, where you're essentially optimizing your DCAs, I could not recommend that more highly, because at the end of the day, you have a certain amount. Let's just, you got $1,000 a month that you want to invest. At the end of the day, do you want to get as many sats as possible for that $1,000? Yes. So
sure.
There's kind of two ways I think about this. I want to identify when not to buy. And the flip side of that is the people who are saying, oh, you should sell and buy back lower. If there is a time where you're going to do that, the times when not to buy is probably close to it, right? So we can talk about what the conditions are that describe that in a second. But the other one is when to buy. And ultimately, you're doing a DCA strategy, but rather than just closing your eyes and, money came into my bank account and you just buy. Instead, you could say, well, I want to wait for a whole bunch of people who bought high to sell low, right? Because I know when I came into this market in 2018, I was that guy. I was like, don't worry, I'll sell here and I'll buy back lower. When I go back and look at all of my sell and buy back lower, it usually ripped immediately after I hit the red button, and I didn't know what to do. And I sat there in like a stunned mullet, and this thing's rallying higher, and I go, shit, I missed it. And then I'll buy back, and then it will tank again, right? Because what I didn't realize is every time I sold to buy back lower, so was everyone else who has no market experience. And we can see this in the on-chain data. I can see my own stupid self making the wrong decision at the wrong time. And this is because human beings will always do this. And then I buy back in at the top. And when I buy back in at the top, it's because the smart money is actually selling at a profit to me. I'm the idiot on both sides of the trade. So ultimately, become the smart money. I do not want to buy my coins when a bunch of guys have held their coins for like 4 years. When they're selling it en masse, I'm sitting back. I'm not buying then because they are exiting. They're going to overwhelm demand. But likewise, a bunch of people don't listen to that advice, and they do buy high, and they wait, and the price goes down. They go, don't worry, it'll come back. It'll come back. It doesn't come back. And then it goes lower and lower, and they finally go, oh, that's it. I can't do it. And then they sell. And you can see when they capitulate all their losses. That's when I step in. So I fully agreed. I think this enhanced DCA idea, it's not the first step, but it's definitely where you should try to get to, because ultimately you're improving how much of the asset you're acquiring. And for me, I look at Bitcoin as a savings asset. I'm getting out of cash because cash is melting. So at the end of the day, I want to own Bitcoin. That's my end objective. Why wouldn't I try and buy as much of it as I can by simply buying when there's blood in the streets? And there's blood always in the streets, over any kind of meaningful time frame. every month you'll get at least one opportunity with some blood. It's almost assured.
Mm-hmm. Yeah, great way to describe it. I mean, you said something interesting as well. It's at the end, it's like a savings vehicle, and that's maybe also something where I usually talk to my friends and try to differentiate between trader, investor, as we did, but maybe even savers. It's again, an investor and a saver is even probably a different person. Because with investing, I feel like a lot of people have the feeling that you want to invest and then wait for a couple of months and then sell it. It's maybe an enhanced trader, but with a saver, they feel like, okay, that's saving for the long term. And maybe Bitcoin is the saving vehicle, and you're a saver. You're actually saving and you're not even investing, So that's something I wanted to throw out here. But I felt like there was a good segue, to move over to this on-chain analysis, of yours that you're so familiar with. And maybe to give a broad overview again, what is this on-chain analysis? And we already hinted at it, how it can help the Bitcoin investor, but maybe if you could quickly say what it is, that would help.
Yeah, so I mean, to kind of, let's start really, really simple. If you're a macroeconomist, you're going to have a whole series of data. Could be jobs numbers, could be employment figures, could be, income streams, profit and loss, whatever it is. You've got a series of metrics and tools that help you understand the economy. If you're a gold buff, you're going to be looking at supply, you're going to be looking at demand, you're going to be looking at central bank buying, ETF buying, all these different metrics describing what's going on with the market structure of that asset. Now, what is Bitcoin? It's a piece of open source software that maintains an append-only spreadsheet, essentially. And that append-only spreadsheet shows you how many coins are in how many addresses, how long they've been held for. We can pull out when the coin was acquired, what date it was acquired at, when it gets spent. We can see the price when it was disposed of. You've now got a profit and a loss. How long it was held for. Is it a 1-year-old coin? Is it a 2-week-old coin? And what we do is we take all of that information. It's like watching money moving around the Swift system. Imagine if you could see money just popping around, but you could judge it based on like how much profit it was in, how much loss it was in. Obviously, because it's cash, wouldn't work with profit and loss, but you can do that for Bitcoin. We can now extract all that information, aggregate it, and we can see some good examples of how we use this. I can see when the hodlers, people who, like you and I, have a very, very high conviction, they step in and they buy a load of coins, usually near bear market bottoms, and then they do nothing for like 2.5 years. And like clockwork, when the price gets back to the previous all-time high and breaks through it, these guys start selling and taking coins off the table. So you start seeing all these 2-year-old and 3-year-old coins spending, locking in big profits. And what we were talking about before, not the best time to be stepping in and buying, strangely enough. Even though we're in a bull market, it's heading higher, the longer this goes on, the more sell side these guys do. So what you're actually looking at is people like you and I who do understand this asset thinking, I'm not going to buy it. I'm not selling now to buy back lower. Some of them may do. Now I'm starting to take chips off the table, whatever purpose it is. Maybe I'm cashing out. Maybe I'm buying something else. Maybe I am getting dry powder. But at the end of the day, at some point, these smart money guys, when they're selling a lot of coin, they're going to overwhelm demand. Not a great time to be stepping in. Wait for the guys who did buy high to sell low, and we can see that behavior as well. You see smart money, you see dumb money. All we're doing is looking at coins moving around the system, but using clever heuristics to identify these guys know what they're doing, these guys not so much. I want to side with these guys and counter trade those guys.
Mm-hmm. Yeah, exactly. Interesting. I mean, I want to go back to what you said way in the beginning, like the long-term holders who then kind of identify this time when they want to buy, and you can see it in the data because they are acquiring coins, but how would you know when they are buying? Like what do they go by? Obviously, it's all subjective. But is there a way to kind of sense that or see it in the data? And what if so, what would you be looking at?
Yeah, so I often use, and maybe it's my engineering background, but I think that Newton's third law works very, very well in the world of markets. And that means that for every seller, there's a buyer. For every buyer, there's a seller. Now, you can generally measure one side of those equations. When we're looking at on-chain data, we're looking at people who currently hold coins. Now, if we talk about when am I very confident that we're getting close to a bear market floor, there's two things primarily. One is in the world of what I call unrealized loss. meaning people who bought during the bear market, but they're price insensitive. High conviction guys who will buy at any price. They don't care that it could go lower. They don't care. They just keep stacking and stacking and stacking. Now, the pain threshold of most people, when an asset is down 75, 80% from the all-time high, there are no speculators. They're gone. And we see them. We see them realize those losses. We see them get completely and utterly flushed. And it usually happens after a couple of really nasty capitulation wicks. So if we think about what does a bear market floor really look like? The market is holding unrealized losses that are so nasty that there is no speculator. Everyone who's a speculator is gone. They just don't stick around longer than that. And we see large locked in or crystallized losses by those speculators. So if you get both of those conditions in play, where it's basically only the hardiest and most price insensitive guys are left in the trenches, that's a good sign. And then if all the guys who were only there for the number go up are gone, who are the sellers? So in many ways, you're looking at this like equal and opposite reaction. Are there enough hodlers in the space? And are we getting a capitulation of the dumb money? And then at a bull market top, it's the exact opposite. Are we seeing the smart money taking profits? The guys who bought low, are they now selling high? And, you know, it's kind of this thing. When you're pitching Bitcoin to your Uber driver, it's probably a good sign. When your Uber driver pitches Bitcoin back to you, you sell everything. Because that means you've got people who are just like that, buying their first coin. This was me in 2017. I bought the absolute top because I had no idea what I was doing. We're looking for that like transition of wealth between these two parties.
Mm-hmm. Okay, very interesting. I mean, the way I understand it is that you say that they're like to kind of detect these bear market bottoms, you know, you would want to look at a lot of realized losses in the system, as well as then kind of, are only the hodlers still around, you know, and like all the people have left, and that you maybe can also see in funding data or like futures data, you know, we can see like not a lot of speculation is going on. I was wondering, I mean, the best time would probably be if they themselves, like the long-term hodlers, if they then also capitulate, you know, because maybe at some point they are also like, I've held now for maybe 3 years, but now, I don't know, maybe Bitcoin is truly over this time and I go out, and that's probably where you really want to go all in, you know, and sell maybe your kidney and your mom's house or whatever, you know.
No, this is for bonus points. Yes. So you will get capitulations by the speculators all the time. Sometimes you get really big ones, and those are usually some kind of macro bottom. However, the bonus points, as you said, when you get long, there's two types of long-term holders. And this is a condition that only exists. So when I talk about long and short-term holders, we calculate this by measuring how long a coin's been held. So the cutoff is about 6 months, 5-6 months. Statistically speaking, coins that hit that 5-6 month holding time, they don't get spent, right? So when they do, you pay attention. Now, because it's that 5-6 months, typically a Bitcoin bear market is like a year and a half. There is a very, very unique point in time. Almost always, when you hear long-term holder in the world of on-chain analysis, long-term holder is usually synonymous with a hodler or smart money, except for one specific point in time, at a bear market bottom. Because at a bear market bottom, the guys who are selling, they bought high and they hodled and they hodled. They're down 30, they're down 40, they're down 50, they're down 60, and they finally get to down 70 and they go, I can't do this anymore. I'm done. So you get two types of long-term holders that panic sell at the bottom, the absolute bottom. The guys who bought high, so long-term holders lock in losses. But then you also get some long-term holders who bought in the previous cycle, and they do think Bitcoin's over, and they lock in profit at the bottom. Those two are the absolute, if you get all three of those, speculators with losses, long-term holders with losses, that's top buyers, and long-term holders with profit, if that all happens at the bottom, I mean, very, very rarely is that not the bottom. So it's one of these great examples of, yes, people do carry this thing the whole way down. And then the flip side of that, the short-term holders, who are the buyers at that point in time, Newton's third law, those buyers, imagine buying an asset that's down 85%. The headlines are horrific. It's going to zero. Everything is telling you the Ponzi scheme is over. The guys who step in right then and there, normally short-term holders are the speculators. In that one specific instance, They are the hardest, most hardcore guys. They are the people who are stepping in when the news is just dead. When FTX blew up, the narrative was Bitcoin was dead for a decade, and yet people still bought. I want to be in the trenches with those guys, and I'll be waiting for them to be saturating the market. That's the perfect time to be getting in.
Nice. Yeah. And for me too as well. That's a great way to put it. Maybe the opposite then, like the cycle top or something, or the local top or whatever. I mean, people have been speculating about this for the last few months, I would say. And maybe we can tie this into this question of where are we right now if we look at these on-chain indicators. How would you go about detecting a global or local top or whatever? And are we in one right now? How would you see that?
Yeah, so this is literally the question that everyone has. So first things first, how do you define a top? A top, and it's important to distinguish a top from the top. So when we talk about a top, we're usually talking about something that's pretty meaningful, right? It's going to precipitate some kind of bear market that follows. Now, there's no question that the ETF rally that we had in March, it is somewhere between a top and the top. We don't know, because until we break above it, or we go much lower, we can't really determine whether it's A or the. So at the moment, let's just call it a top. We saw a huge amount of realized profit. Guys who bought low, those guys I was talking about in the trenches down the bottom, they started selling in large size, taking big profit, and basically taking chips off the table, right? Now, it wasn't the same magnitude as the 2021 or the 2017 peak. So in that regard, it was a meaningful top. It was enough to obviously stall the market out, but it didn't have the same kind of I think it's over energy to it. Now, on the flip side of that, meaning what happens after that top, then we start to analyze the behavior of people who are inside that market. Now, the best way I can describe this is I go looking for this concept called top heaviness. So a full angry bear market is going to have too many people buying too many coins at too high of a price. Now, we don't really have the too many people thing, because the vast majority of people in this market, there was a bit of a burst of ETF buyers, but a lot of those ETF buyers are actually hodlers like you and I, who finally got a chance to shove their retirement in a very, very easy manner, right? So you've kind of got just more hodler money. They're price insensitive. There was very little retail. If you look at Google Trends for Bitcoin and crypto is below the FTX bottom. We're back at 2013 level. There's no there's no Uber drivers buying Bitcoin right now. So we really didn't have the too many people thing. Buying too many coins. We did see this, actually. We did see people buying too many coins. And the question is, at too high of a price. So you're kind of trying to get these three different elements. If you've got too many people, too many coins, too high of a price. The too high of a price one is really interesting, because we've gone through a period in time when short-term holders, people who've held their coins less than 5 months, 100% of them, all of them were underwater. We've been down we traded up to 73 and we sold off down to 53, and we got down to 49 at one point. At that point in time, everyone who bought in the last 5 months was down. However, their cost basis, yes, their coin was underwater, but it wasn't underwater by 30%. It was underwater by 5%. And in a world of Bitcoin, if you've got a lot of hodlers and you're down 5%, that's another day in Bitcoin, right? This doesn't faze me at all. If you're down 30% at scale, now you start to break sentiment. And we just haven't had that last component of too many people at too high of a price. We got too many coins, but we didn't get too many people at too high of a price. And this is a really interesting dynamic. So if I really, there's a lot of kind of bits there, and there's a lot of detail involved, but if you really take a step back and say, where is the market right now? It looks like a top has been established, but we haven't seen bear market behavior on the other side of it. What we've seen is hodlers waiting and allowing the market to come to them so they can do optimized DCA, exactly what we were talking about before. This is the market that we're in. What I really see is lots and lots of people doing exactly what I'm doing and being like, 60K, I'll wait, 60K, 58, okay, right? And they're waiting for that opportunity to actually buy. The bid is still there, but we haven't seen this kind of really nasty cascading bear effect. A lot of people are bearish, but we're not seeing the behavior of bearishness. And that's, I think, a big difference.
Yeah, well laid out, like so interesting. I mean, what I find so interesting is that, like, you know, when you talk to outsiders, I mean, I have a lot of friends who really thought they missed the boat, you know, and they now, like, because Bitcoin has come back like many times, you know, from 2017 and now 2021, and now with the ETFs, they really think like, okay, there's something to this asset, you know, and I also want to go in. So that's kind of what I see, you know, like a lot of people, and obviously they're not my friends, none of them, they're not going in with a hundred thousands of dollars, but still they're going in at some point, which I find interesting. And it seems like they will yet to be tested, you know, if they can really have this halter mentality.
Oh, yes.
But I feel like, and they will be tested for sure. But that's something that I see, which is interesting. But then at the same time, if I talk to people who are in the trenches have been for quite a while, they're also bringing the argument, yeah, maybe this time these cycles are different, or we don't have this typical 4-year cycle anymore, because, like, as you said, like all the retail guys that we have been calling for, they have not come, but maybe they never will come back. And so maybe this is one of the last questions I would like to ask you. How do you see it with these market cycles? You know, is it going to be different going forward? Maybe a little more sophisticated, because like that it will be broken entirely. I can't see this because, as you said, it's coming back to human psyche, you know, and humans don't change. So I would assume that there will be another cycle, bear, bottom, and then also like top with a bull. So how do you see that?
Yeah, I'm going to give you a very, very hand-wavy answer here and say that I simultaneously believe that the 4-year cycle will continue, because so far it just seems to continue to work, and it simultaneously has already broken. Now, what do I mean by that? Because that sounds very useless. It's like, oh, it works and it doesn't. You kind of have to assume that it could happen, right? Because it continues to happen. People expect it to happen, but there is no reason why it needs to happen. And that's the distinction, right? It doesn't need to happen. So a lot of people, like, I know the top's going to be November 15, 2025, because my left translated upside down triangle cycle. And I'm like, based on what? Based on absolutely what? The world is constantly changing. We could go through all manner of things that will completely shift the power dynamics. We don't know who's going to buy, how much they're going to buy, when they're going to buy. We don't know any of these things. The great variable in a bull market is demand. We have no clue who's going to come on. And trying to predict that, I think, is a fool's errand, right? You really don't know until the point in time. What we do know is when people sell, because we can see it. We can literally observe it in the on-chain data. So by Newton's third law, we look to measure when people start to sell, it's going to overwhelm demand at some point in time. So rather than worrying so much about, is the cycle going to persist? People say, when do you think it will top? What price do you think it will top? And I say, I don't care. I want to show me the behavior of topping behavior, and then I'll check the date, and then I'll check the price. Because at the end of the day, if people anchor to it's got to go 8x or it's got to go 5x because of diminishing returns, or it has to be in November 2025, based on what? Right? There's rarely ever any kind of evidence for it. It's like, oh, but my cycle. It's like, but just show me when there's too much sell side. That's all I care about. And then I will check what price it's at. So I try to flip it around and go, show me the market structure that puts a top in. Then I'll worry about what the price is. And I think that's in terms of the market cycle, it will go as long as it needs to go until supply completely and utterly overwhelms demand. And that's the mechanic.
Yeah, exactly. No, that's great. I mean, in the end, I would say the way I would put it is really, as we established, you know, markets are moving in unpredictable ways. But then again, you know, like this would also be the signal for people to take away. I guess it's like it's going to happen, but probably in a way we don't expect, you know, and that's always how it markets. Yeah, there is some like rhyme to it, you know, because history rhymes, you know, that's also what we know, but we never know how exactly it rhymes. So
you want to try and remove your biases. If you anchor to a bias of it needs to be this price, if it doesn't get there, you're going to be anchored to that price, and then you go, well, hang on a second, but I wasn't prepared for it to not hit it. Remove that bias completely by not worrying about the price. That's how I like to think about things.
Yeah, exactly. Well, James, thanks a lot for all these valuable insights. Definitely a lot of signal in there. Maybe one last question that I ask to everyone is really like, if you could name one high signal person you maybe personally know and that you would want to see on that podcast, and then also what question or topic you would address with that person. Is there anyone that comes to mind?
Strangely enough, I actually asked the man to talk to him today, Alex Thorne. I really like Alex from Galaxy Digital. I think he's got a really, really interesting. He's been around the space for a long time. He's got a fantastic research team, so he gets to kind of see how the mechanics and the nuts and bolts fit together. And I mean, we were actually on a panel together in Nashville, and the question was about the cycles. So I think if there was going to be a question that I'd ask towards him, it would be, how has this kind of ETF institutionalization, what are the big things that it's ultimately changed for Bitcoin moving forward? I've certainly got my ideas of what it changes, but like if there was like one or two things that you think these ETFs have ultimately changed, what's the biggest impact? What would they look like?
Yeah, great question. Yeah, Alex, I've been following him as well, and maybe at some point it would be nice to talk to him exactly about these kind of topics. Well, great. Yeah, James, thanks a lot. Maybe just to finish up, where can people find you? Where can they follow you, support you? Yeah, just drop it all here.
Yeah, so you'll find me over at Twitter or X at @_Checkmate. And you'll find all the work we're doing over at checkonchain.com. One word, check on chain. And that's where you'll find we've got a charting website with all the charts I was talking about today and plenty more, as well as our newsletter where we really talk about these market dynamics twice a week.
Yeah, great. And people probably know these charts because I've been using them already myself a lot. So just really great. I would say a source for everyone to go to. So thanks, James, for your time, and have a great one. And hopefully talk to you at any time in the future again.
Thanks, mate. It was a pleasure.
Bye.